Imagine a time when computers couldn't talk to each other. When sending an email meant using the exact same hardware and software as your recipient. Or navigating global finance through a maze of slow, error-prone manual messages. Sounds inefficient, right? Yet, in the burgeoning world of digital money, we face a remarkably similar challenge today. The stablecoin challenge, a protocol war. We hear a lot about stablecoins, digital currencies designed to hold a stable value, often pegged to the US dollar. They promise instant global transactions and a revolution in finance. But the race for dominance isn't a battle of who has the best app, it's a protocol war. Different fintechs, crypto firms, and even traditional banks are deploying their own proprietary networks, each an isolated island. They connect only through high-risk bridges, which act as a tax on liquidity and introduce security vulnerabilities. This fragmented, non-interoperable topology is inefficient, unsustainable, and introduces unnecessary risks. The market isn't waiting for a better user interface, it's waiting for a unifying standard. Lessons from history, the triumph of open protocols. To truly understand the solution, we must look to the history of successful networks. The pattern is strikingly clear. Early computer networks were complex, proprietary systems like DECnet and SNA, leading to vendor lock-in. Innovation was stifled. Then, funded by DARPA, came TCP/IP, the Transmission Control Protocol Internet Protocol. It was revolutionary because it was simple, open, and neutral. It didn't try to solve every problem, it simply focused on delivering data packets, decoupling applications from physical networks. This dumb network philosophy allowed all the smart innovation, from email to the World Wide Web, to happen at the edges. Anyone could build on it, permissionlessly. January 4, 1983, when ARPANET adopted TCP/IP, marked the true birth of our modern internet. The same principles apply to global finance. Before 1973, international banking relied on slow, error-prone telex messages, lacking any standard format. A consortium of banks stepped in and built SWIFT, the Society for Worldwide Interbank Financial Telecommunication. SWIFT doesn't move money, it's a secure messaging protocol that created a universal language for financial instructions. It became the trusted infrastructure backbone of global finance because it was a neutral utility governed by its members. Similarly, the modern credit card system began as a proprietary Bank of America product called Bank AmeriCard. Its potential was unlocked only when control was given to a member-owned cooperative, later rebranded as Visa. Visa established standard rules and a shared technical infrastructure, ensuring a transaction from any member bank was honored by any other. In all these cases, open, neutral protocols always defeated proprietary systems and unlocked exponential global scale. The solution: building the Internet of Value. These histories show an identical pattern. A network needs a foundational protocol to achieve global scale. The protocol must be open, neutral, and governed for the collective benefit of its ecosystem. The stablecoin market is at this same inflection point. The solution is not another stablecoin product, but a new architecture for digital value, a TCP/IP for money. This requires proper engineering, a modular 4-layer protocol stack, robust and adaptable, much like the TCP/IP suite that powers the internet. Each layer solves one core problem well, creating a system that is secure, scalable, and built to evolve. Layer 1, the settlement layer, universal transport. Layer 1, the settlement layer, the Universal Transport Protocol. This foundational layer tackles interoperability head-on. Its purpose is to create a standard data packet for value and a universal routing system that abstracts the underlying blockchain. Think of it as IPv6 for money. It allows a stablecoin packet to be routed seamlessly across any blockchain, public or private. The underlying network becomes an implementation detail, not a dependency. This eliminates the fragmentation caused by today's incompatible blockchains. Key technologies driving this include Chainlink's cross-chain interoperability protocol, or CCIP, Layer 0, and Axelar network, all working to securely pass messages and value between disparate ecosystems. Layer 2, the asset layer, verifiable collateral. Layer 2, the asset layer, verifiable collateral. This layer solves the crucial problem of trust in the stablecoin's value. It guarantees the stablecoin is always fully backed, one-to-one by the highest quality liquid assets, not risky, less transparent assets that have caused past instabilities. We're talking short-term US Treasury bills and reverse repo agreements. The cornerstone here is Chainlink Proof of Reserve. This service uses a decentralized Oracle network to continuously monitor off-chain reserves in real time and post that data directly on-chain. This replaces opaque, periodic monthly attestations with continuous, live, cryptographically secured proof. You no longer need to just trust an auditor's report. You can verify the data yourself at any moment. This layer also mandates a circuit breaker, an automated, trustless control that immediately pauses all new stablecoin minting if reserves ever fall below 100% collateralization, preventing the issuance of unbacked assets. Layer 3, the compliance layer, programmable identity. Layer 3, the compliance layer, programmable identity. This layer addresses the critical issue of trust in the counterparty by embedding regulatory compliance directly into the protocol itself, all while preserving user privacy. It leverages emerging open standards for decentralized identity, like decentralized identifiers, or DIDs, and verifiable credentials, or VCs. Here's how it works. A user verifies their identity once with a trusted issuer, perhaps their bank or a specialized KYC provider. They then receive a non-transferable, verifiable credential stored securely in their personal digital wallet. When a transaction occurs, the system can use zero-knowledge proofs to verify specific attributes. For example, is this user from a non-sanctioned jurisdiction, without the user ever revealing their underlying personal data. This automates compliance, significantly reducing overhead and enabling access to regulated financial products. It can also integrate with leading blockchain analytics platforms like Chainalysis and Elliptic to automatically block transactions with high-risk addresses, fulfilling global anti-money laundering and counter-financing of terrorism requirements. Layer 4, the distribution layer, open interfaces. Layer 4, the distribution layer, open interfaces. The final layer solves the crucial last-mile problem of getting digital money into the hands of billions of users. It provides open standardized application programming interfaces, or APIs. Much like how Stripe or Plaid revolutionized online payments and financial data, this layer offers simple, well-documented tools for any third party, banks, fintechs, merchants, or app developers, to integrate with the protocol for minting, redemption, and payments. Crucially, the entity that builds this foundational protocol stack does not build the end-user applications. Instead, it provides the neutral, reliable rails. This empowers the world's existing financial networks to become the on-ramps and off-ramps, creating a powerful network effect. Easy integration drives adoption. More applications create more utility, and that in turn incentivizes even more innovation on the platform. It's how we scale digital value globally. The integrated stack, the blueprint for a new finance. These 4 layers are not independent, they are a single, cohesive architecture. This integrated stack solves the 4 critical problems plaguing digital money today. Interoperability, through the settlement layer, asset trust, through the asset layer, counterparty trust, through the compliance layer, and global distribution, through the open interfaces. This isn't just a theoretical exercise, it's the technical blueprint for a financial system that is fundamentally open, transparent, and built on verifiable proof, not just promises or centralized attestations. It's the infrastructure for the next generation of finance. The protocol always wins, the Internet of Value. The components are available. The design principles are understood. History has shown us time and again that the protocol always wins. The company that builds and owns this open, neutral, and stable protocol stack will not be competing on product features or flashy apps. It will win by becoming the fundamental, trusted standard that everyone else builds upon, capturing the market not by having the best application, but by defining the foundational protocol itself. This is not just another opportunity, it's about laying the essential infrastructure for the next generation of global finance. The standard is there to be built. The market is there to be taken. This is the Internet of Value. What are your thoughts on this vision for the Internet of Value? Do you see a future where digital money flows as freely as information? Share your insights and predictions in the comments below. If you found this deep dive valuable, please like this video, subscribe to our channel for more insights into the future of money, and hit the notification bell so you don't miss our next upload.